Most everyone understands the benefit of trade. You know, Dallas enters into trade agreements or trades with Chicago and Poughkeepsie, New York, and Los Angeles, and they're the better for it, and they're the wealthier for it. Much better than they would be if they just took and restricted trade into their own city limits. But a strange thing happens when we consider trade with other countries. In that larger arena, many come to view trading partners as opponents who must lose if we are to win, and vice versa. As a result, many believe that for America to get its share, our government must put its thumb on the scales of the international marketplace through so-called fair trade practices. The phrase fair trade is good rhetoric. It sounds a lot better than unfair trade. But the rhetoric, however, fails to square with reality. And the fair trade results, or really brings about one thing, and that's called protectivism. And protectivism, which involves almost any government attempt to limit free trade with foreign traders, is always promoted for its benefits. And what are those benefits? Protect jobs, protect the environment, protect our way of life. And how do we protect those things? With tariffs, taxes, or with import quotas. And how does that help us? The end result of tariffs and import quotas winds up being higher import costs. Who pays those costs? We do. Even, let's take, for instance, you know, we're going to take in, let's say somebody's making wheelbarrows, you know, outside of the country, and somebody's making them inside the country, and the domestic wheelbarrow manufacturer is doing a bad job, all right? And he's getting killed in the market because the foreign wheelbarrows are much better made, and actually they're a little bit cheaper. And so the domestic wheelbarrow manufacturer goes to the government and says, you know, I got a problem, you know. We're losing our business, you know, and we got all these employees and everything else, we need some help. So they put a tariff, you know, on the imported wheelbarrows, and all of a sudden the imported wheelbarrow is more expensive. Well, as the foreign manufacturer delivers them to the U.S., he pays the tariff to the U.S. government. But that tariff stays with the price of the wheelbarrow, and when the consumer pays it, he gives it back to the foreign government that paid the foreign manufacturer pays the government. We pay that. And why do we pay that? We pay that in order to be able to buy an inferior product. Now then, if the government didn't get involved, what would happen to that manufacturer of the inferior wheelbarrow?
He'd either get it straight.
Go out of business. And so then we have one manufacturer, a foreign manufacturer, providing wheelbarrows. But we live in a great country. We're full of entrepreneurs and smart people. You know what we do, or someone will do? They'll see an opportunity of building a better wheelbarrow cheaper than the foreign manufacturer will, and that's what will happen. Without government interference, we all gain, we all win. With government interference and with free trade, and with tariffs, we all lose, except for a very select group of people, and they eventually will also lose too. So, a good example, you know, of what happens, and this is a real situation. We go back to 1930. The country was kind of rough right then. We just had gone through the stock market crash in 1929. It was kind of struggling in 1930. Congress, in its wisdom, passed the Smoot-Hawley Tariff Act. Huge tariffs. The average tariff on there was 20%, but some of them were as high as 30%. There were some people that actually even considered the fact that maybe when Congress was debating this bill in 1929, it had a significant input into the fact that the market did crash. But that's just speculation. But anyway, so they passed this tariff bill. It averages 20% import tax, drove production costs up. Okay, because you buy an import to go into your manufacturing facility, you're paying more for it because the tariffs are there. If you're just going to buy a product that's manufactured in another country, the price of that product's going to go up. What does that do? That leaves you with less money to spend on other things. So the tariff is already, you know, not only are you paying money to the government, but you have less money to do for the things you may want to do. Okay, it reduces sales when the prices go up, what sales go down. And then what happens when you do something like raise the tariff on somebody? Retaliation takes place, right? And so all of a sudden, all the European countries are raising tariffs too because they're getting even with us. So the spiral begins then, you know, higher prices, lower sales, layoff of jobs, and it goes around and around and around, okay? And what happens? We had a depression. Well, it wasn't the only thing that caused the depression, but it was a significant part of it. That tariff bill reduced imports by 4 to 8% in nominal terms. It's responsible for 1/4 of the 40% decline in imports after 1930. It reduced GDP by 2% in the 30s, and at any other time, all the things being equal, would have by itself induced a recession. Our Congress passed that kind of a law and put us into a recession, all in the name of fair trade. So we need to watch out for what these guys are doing. The last thing I want to talk about before I turn it over to Tom is outsourcing. We hear a lot about this, and a lot of people are really upset with losing jobs, and free trade is costing us a fortune. But this is a fact. American firms are shackled by onerous labor and environmental regulations, sometimes relocate to countries with less costly business environments. When they do, they are criticized for outsourcing American jobs and creating unemployment in the U.S. Free trade treaties such as NAFTA also are accused of encouraging such job losses because they do not allow taxes or tariffs to be imposed on outsourced goods. Facts. It accounts for less than, outsourcing we're talking about, it accounts for less than 1% of gross job turnover per year. In fact, only 2% of job turnovers in the U.S. is due to trade in general. The U.S. economy actually added 25 million jobs during NAFTA's first 13 years. And U.S. manufacturing output rose 63% compared with only 37% during the preceding period. According to reports issued in October 2007 by the Department of Commerce, the U.S. economy grew by 50% during NAFTA's first 13 years. It doesn't sound like it's too bad to me. But there's a lot of people who are opposed to it. And they're opposed to it at your expense. Let me just conclude with this statement. Despite the overwhelming benefit of free trade in the United States, challenges to it multiply like bacteria in a warm Petri dish. To overcome those challenges, the U.S. should guard against high corporate tax rates, expensive and inefficient job training and retraining programs, costly and counterproductive regulations, and other misguided policies that undermine the competitiveness of American workers and firms. These burdens, not free trade, are the real threats to our nation's economy. Free trade won't usher in utopia, of course, but over time, it is the best known way to reduce poverty and create wealth for entire nations. So that's when an amateur gets to speak to you. Maybe next time we get somebody who knows a little bit more about it. Tom, are you ready to